Well, we want to welcome everybody here. Welcome to today's Gravitas Impacts Global Business Leader Forum. I'm Carter Heim. I'm CEO of Heim Lance, a CPA firm in Annapolis, Maryland. I've been CEO of that company for 25 years. I'm a Gravitas Impact Senior Coach, been a CPA for over 40 years, and I live in Annapolis, Maryland on the US East Coast. So today's topic is top 10 reasons why every entrepreneur should have a CFO. And our speaker today is Dominic Ben-Savenga of the A-Team. He is president principal with the A-Team Consulting since 2013. He has 24 years in business as a fractional CFO, and I'm sure Dominic will tell us what that means in a few minutes, and 12 years of a corporate career at Citibank in their retail bank division. He's a born and bred New Yorker. So, as I said, Dominic is the president of the A-Team Consulting, your accounting team from the boardroom to the back office. They've been in business for over 19 years, since 2001. Their office is in New York City in Midtown. They have a staff of 20. They have 4 CFOs, 4 controllers, and the rest are bookkeepers. And they work with over 100 active clients nationwide. So Dominic, with that, tell us about why should every entrepreneur have a CFO?
Thank you, Carter. And very happy to be here. Very pleased to be with the Gravitas community and take this topic from my expertise. What I'd like to do today is walk through what are reasons I've seen of why you should have a CFO in general, and then why a fractional CFO makes sense for a lot of organizations. Today, when I say CFO, I also referring to a fractional CFO. They are interchangeable for the most part. We're looking at a situation where you need to have a chief financial officer, someone who is your most important finance manager, executive in your organization. And if you can't afford that person on a full-time budget, which can go anywhere depending upon the region and experience, from $150,000 to $300,000 for a small entrepreneurial business, you can bring someone on a part-time basis, which is what I've been doing for 24 years, where somebody has had my services on a day a week or 2-day a week basis, a day a month basis. So that's the way you get the expertise of someone with all those years of experience, and you bring it down into a very manageable budget. Today's CFO, it's a very different role than it was, let's just say, even 20 years ago. Today's CFO is not your father's or your mother's CFO. They are in a very different space. A CFO today should be a partner in defining your business model. They should be executing that business model with you, not just controlling it. The control functions are just for that, for controllers. So there's a big difference between the person who's in the strategic CFO role and the controller who's a little bit more on the debits and the credits and closing the book side, although ultimately the CFO is responsible for that. They should be looking at your business and looking at identifying your risks and opportunities, not just monitoring it, but thinking ahead for you, communicating a vision for you, driving significant cost reductions. And in today's world, if they're not intellectually curious about technology, I think they're at a deficit. There's so many different ways that technology is helping finance departments and businesses. And when you bring that together in this kind of role, what I see is the best CFOs, fractional or not, are a partner to the president, CEO, entrepreneur, a strategist, and an operational driver, just not a bean counter.
Dominic, when I look at that list, that is very much in the present and in the future that you're counting on your CFO to help you with, right?
Correct.
It's using the past to inform, but it's informing action. And that's one of the things you're looking for your CFO to do for you.
Correct. So today, if you're sitting in your role as an entrepreneur and you've got someone giving you reports and only giving you reports of what happened in the past, then you're not necessarily getting the functions you can be getting from a CFO. And also to think ahead, whether in your business that means a month or 3 months or 3 years. Particularly in the COVID crisis world, everybody's thinking ahead in much shorter terms, but still, you need to be thinking ahead next week, next month, next year. Top 10 reasons. I broke this up a little like a David Letterman kind of list, if everybody remembers him. Reason number 10, a fractional CFO is an active partner in your business at the center of your business, impacting and interacting with your many stakeholders. You have a ton of stakeholders in your business. You have a management team. You may have partners, you have coaches, banks, your employees. Unfortunately, government agencies have a hand in your business, whether you like it or not. The IRS, your state agencies, your Department of Labor's. You need insurance and risk management. All these pieces are out there. And you might have all of these things, but in my mind, when I step into these roles, I am at the center of all those relationships, and I'm taking away the day-to-day activities and sometimes even the strategic thinking on a lot of this from the entrepreneur. This is the line I use all the time with prospective clients. You go do what you do best. So, Mr. or Mrs. Entrepreneur, are you really good at sales, design, being a doctor, being a lawyer, being an accountant? You go do what you do best. Let the CFO go do what they do best. And that partnership is how I see this role and what I've been able to accomplish over 24 years of doing this.
And so, Dominic, let's stick with that just for 1 minute. Why is it so important to the entrepreneur that these relationships be maintained? Because I've known many entrepreneurs, they think about their bank when they need something from their bank, right? They think about the government agency when the government agency comes knocking on the door or when they need something from the government agency. But what happens with the CFO in this role that you are telling us about?
You're building up a lot of equity in those relationships over those years of doing this, so that when you're in these crises like we're in now, that equity you've built up in those banking relationships or the relationship you have with your partner, even your employees, those equity in those relationships will carry you through in this moment right now and get you some leverage you might need. I don't know what kind of leverage you might have needed in this crisis for any one of the businesses out there, but over the last 3 to 4 months, I have seen every one of my clients need something from one of these stakeholders, whether it be a PPP loan, or they need to extend the terms of their loans or lines of credit, or they needed to tell their employees, listen, you got to go to a 3-day work week for the next 3 months for us to survive. You can get that done when you've got these relationships built the way I'm suggesting you would do. So a CFO who comes in with the right role and attitude thinks differently than you or your staff. That's our role. We come at it from a different angle, the way your CPA does. But most importantly, we don't get attached emotionally to your business. This is particularly true with a part-time or a fractional CFO. I could look at things in very much of a black and white, provide a very objective review of your key decision points, often mediate opinions and differing opinions on your management team, and try to get down to this bottom line. And I don't live in a black and white world, but sometimes you have to make decisions that are black or white. I try to look at the grays, but sometimes you have to do that. So the other thing I brought up is if you're looking to bring someone in, these are the character traits I think you'd want in a CFO. You want calm and thoughtful. If your CFO is a really emotional kind of person who's just constantly full of this emotional internal energy and is constantly coming out on your team, they should be on the back. When they're sitting in meetings, they say things very infrequently, but when they say something, it's really impactful. They should be authentic with you and your team. You should be able to talk to them. They should be able to talk to you. They should be brutally truthful about the facts. I think one of the things that does not happen enough with entrepreneurs is they get the brutal truth. And sometimes you have to have that truth. And then that groundedness, I think, is another part of what makes a good fractional and or full-time CFO. That they come at things and can offer a perspective that is very, very grounded, not only in the facts, but in the reality of what's going on in your business. You know, I look at it as a right-hand person, right? When I was in my corporate career, which was at Citibank, I played a role, 2 stints, probably all of 4 years together, the chief of staff. So finance was just part of that role, but being the chief of staff meant I was in the background at all those meetings. My immediate supervisor leader, who was running our department, was always up front saying it, just like the entrepreneur in the business should always be up front, be the leader. But I was in the background as the team member that they most relied upon, almost always. And I think that's how I see the CFO role. Someone who pays attention to all aspects of your financial picture is our number 8 reason, big issues and small. I think it's a great quote, a coach that I heard write it out in an email newsletter. The numbers don't tell the complete story. You need to understand what, who, and how the numbers are being driven. So I don't know how many people this would resonate with, but I would suspect quite a few. Sometimes you just see a report And it doesn't tell the story. You have extraordinary revenue for some reason in a particular period because it was a one-time non-recurring item, either an expense or a revenue. I remember a story once, this was very early in my career, very, very seasoned. It was a blue-collar kind of business, really smart entrepreneur. And I walked in with a set of numbers someone on my staff put together, and he told me they were all wrong. And I said, what do you mean they're all wrong? He says, I know my business. I know what's going on. These aren't right. And sure enough, the bookkeeper had done something that was a little bit off that we had to go correct. But this business owner, he knew that what, how, and what was driving all of his numbers, and he's keeping it almost in his head. And he was telling me, if you're telling me I did $1 million last month, by example, I know it was 1.3 or 1.4 because this, and this. So I think that's an important point, that you need to have the CFO who is understanding those numbers and getting very aligned with how those numbers are being driven by your KPIs and your metrics. So you should have your KPIs and metrics. The Gravitas Impact Coaching process goes through all of that in your stages of agile growth. So you need to have that alignment, but more importantly, you need to have the CFO know who's driving that KPI metric, so he or she knows to go to that person and has a handle on if you're going to miss that metric, or maybe you're going to be above that metric. But that CFO is rarely ever surprised when the numbers come in, because when the numbers are coming in, they're seeing that the KPI was consistent, if the KPI is a good measurement of your results with what's going on with that driver. Number 7, CFO usually comes from outside your industry and brings a fresh management perspective. This is particularly true, I think, in the fractional CFO world. The number one question I get asked by a prospect is, have you worked in my industry in the past? And I say that's the wrong question. I think that your debits and credits and how you're going to do that, as accountants know, are roughly the same in just about every business. And there's probably a small part of every industry that has some unique accounting rules that you need to take into account. But what to know about the business and how to get a handle on what's going on inside your business and your industry is something anybody, a fractional or full-time CFO, doesn't pick up immediately. But once they understand what's going on in your business and brings in their own perspective, that will make a huge difference in your business. That new set of perspectives to help you see things that maybe you're just not seeing the same way.
I think lots of times the question is more important than the answer. Essentially, your CFO is sitting there as a catalyst at times to help the leadership really analyze something and consider different perspectives.
I agree. Number 6, a CFO is a voice of finance in your management team. The financial impact of every decision is reviewed. To the first bullet point, I've often been brought into management teams that have never had a finance view brought in. So you got the entrepreneur, he's got his sales and or marketing person, distribution person, design person, bunch of different technical skills, but they leave out their bookkeeper or even their controller. And it almost always comes back to haunt them because they're not making every decision and giving every decision some sort of view from the CFO's standpoint. So CFOs are going to think differently. They're going to question differently. They're going to come to the table, as you just mentioned, Carter, with different kinds of questions. And we could take a very hard look at all sorts of spending and be unattached to the recommendations. And if we are in the part-time fractional role, we particularly won't come in with any sacred cows. There's nothing that's going to be, hey, we can't change that. And the last thing I like to say is you very often can use me and or your part-time CFO as a deflection, delay tactic. You don't want to make that decision with that employee. Maybe you don't want to tell them what you already know the answer is, which is no, that they don't want to hear. So you say, let me check with Dominic. Because you can then just go and say, I did check with him and Dominic said, no, we can't do it. So now it's not you're the bad guy. You could also say, let me check with Dominic, and then have Dominic or your part-time CFO step in and actually go tell that person that. There's an amazing kind of gravitas that I get as the outside part-time CFO in many businesses, and the right entrepreneurs use it exactly like I'm telling you here, because you're making tough decisions all the time, and you know those decisions can very often get in the way of that relationship you have with your key executives or a key employee. But it's a good tactic, I think, that actually works, because very often you know your answer when they're talking to you, but you just don't want to be the one who's going to give them the disappointing news. Reason number 5, So we talked in one of the first slides about being proactive and building relationships. I don't think there's any bigger, better, more important relationship, especially when you're growing, than your banking and lending relationship. So the first reason the CFO is an important role here is we talk the same language. Just like we talk the same language with CPAs, we talk the same language with bankers. It helps in my case that I have also been a banker, but most CFOs have been through hundreds of kinds of packages with bank lines, term loans, asset-based lending. They've seen it all. They can understand what the banker's talking about, slim it down so the entrepreneur can understand what they're offering and what they're not offering. And also present your company in the best light, because sometimes bankers are very black and white in their underwriting, and other times they allow that gray, and that gray is in your relationship manageability to really sell their underwriting team on it. I've seen this happen many times, and if you could keep getting them pushing for you, that you get the most out of it. Lastly, by being exposed to many lenders, and I know lenders in all different types and ilks, you get a bird's eye view of all the trends that are out there. You start to see the different things that are going on in industries. And it's just something else you bring back as a CFO to the entrepreneur, and you bring back the fresh perspective, and you bring back in, because a lot of entrepreneurs and their teams tend to get very narrowly focused in their lane of their industry and only see it that way. And even sometimes smaller than that. My industry in my area of the country, or my industry in my little size of the business, but maybe the mid-size and the larger companies doing something that you need to know about. Number 4, the CFO is proactive in managing your cash flow, accounts receivable, et cetera, et cetera. Obviously, in current times, this is the most important thing that's going on for a lot of businesses, managing cash flow. You know, burn rates used to be a discussion about how much cash you had that's going to last you, for companies that were getting equity investors until their next round of financing. And now small businesses and entrepreneurs are doing it in this environment to say, how long can I hold out and wait through this crisis until I can get back to some new normal? So you need to know that, and a CFO can be in there and know what's that burn rate, what's my cash runway, and not just back of the envelope stuff. I'm talking analytical stuff. Really understand. We're being paid in 30 days on average pre-crisis. It suddenly went to 50. Well, that's a big impact on my cash flow. And that means I might have less time than I thought. And I need to factor that in. The money in the bank is never really the answer. And my question here is a rhetorical one, but it's also based upon an example. I have a client who's got $7 million in the bank, and everybody will go, wow, it's only 4 months of operating expenses. It's not enough. And I keep telling my client that. Fortunately for them, the COVID crisis hasn't hurt them that much. We're in an initiative now. By the end of the year, we hope to have 6 months worth of expenses, which has been a goal we put in place 18 months ago to get to. And we did not need to rely on it, but it has put us in a very comfortable position when this crisis hit in March and April, when I went straight to them after just 2 weeks of looking at the books and said, we've got nothing to worry about. We could lose all our business the rest of the year. We've got enough money to cover us. Because even though we had only 4 months, I knew if we started to make certain cuts, we would make that stretch out longer. So $7 million is not the number. It's how much of that can you make last in crisis mode? What is it like your rainy day fund? Just like any personal financial advisor will tell us what we need personally to have in the bank in an emergency fund, I believe every business owner, every entrepreneur should be having that in the bank today and be working towards that. It's one of the key lessons, I think, for most businesses out of this crisis. I'm sure you've seen that too.
Yes. And what this points out too, I think, is your earlier comment about understanding the relationships of the numbers in the business and the different aspects of the business, so that when you turn one dial, flip a switch, something changes, what's that impact going to be? Such as you described, with maybe a slowdown in collection of receivables. Maybe we arrange for some other kind of financing. We can manage our cost, our personnel, but being able to see that we can take this effect, the effect does not show up overnight, understanding what time period that will show up and what that means to the overall strength and safety of the business.
And sometimes, Carter, a decision about whether I want to do those things, or maybe it's my own equity that I've taken out of the business over the years that I want to pull back because I believe in this business, But sometimes you look at it and you're saying, if you really want to be brutally honest, I'm not going to go back to where it was for a very long time. So do I want to put that investment in? Or do I want to put that personal guarantee on the line for that bank loan increase?
Yes.
Because I'm looking at a very changed business and market right now. And if I can't make that pivot, I might need to reconsider what I'm doing here.
Yes. Again, it's looking out that front window where you're going versus making decisions because when we look in the back, everything's okay.
Right. Reason number 3, a CFO, as you know, in the 5th attribute of agile growth in the gravitas world, could look at your company metrics, profitability, and then how do they optimize that cash flow? What are your drivers and your levers to control and increase your profit and cash? Your CFO should absolutely be the keeper of these KPIs, not the one who only solely develops them, because I think the organization needs to, as a management team, pull that together themselves, but certainly owns the actual tracking and reporting against them. And it should be a very simple dashboard: green, yellow, red. We should be not talking about the greens, worrying about the yellows, and focusing our efforts on the reds. What's wrong with this metric? Why is it red? And what do we got to do to turn it back to yellow and back on its way to green? And I think when you start to have a CFO who can put those kinds of things together for you, what you're doing is simplifying the way you manage the business. Because you've determined already with your coach or your management team, these are the most important drivers. These are the things we're tracking. Our scorecard is going to tell us where we're at, and we're going to react to our scorecard.
And when you do that scorecard, how substantive are your discussions about those items on the scorecard versus when you just start with financial statements or with all kinds of other reports? Do you spend as much time with the key numbers, or do you spend more time with the things that really matter to the business when you do this scorecard that you're describing?
Interesting thing about when I've gone through this process with clients who really buy into all of this, and we've done a lot of it, you wind up having very long financial statements on pieces of paper that only you and the controller ever look at, and you never really share with anybody. Because what matters are these dashboards, KPIs, and the very top line numbers, and then your cash flow projections and your income statement projections for going forward. So this is one at your heart. CFO will develop a very strong relation with your CPA. Most people rely on your CPA to get that tax return, that legal regulatory document in, and tell me how much I'm going to pay. And let's also talk about how I can't pay that much that I paid this year, next year. But I think there's so much more you should be doing with your CPA, and the CFO can do that. They too have very, very broad experiences. They have seen hundreds, if not thousands, of businesses over the years, trends and what goes on in businesses, what worked well, what hasn't worked well. They have access to different kinds of networks of people, whether they be different lawyers, insurance brokers, other bankers, other lenders. They're part of the team, and as a CFO, I like to make them part of my team and have that relationship. The third point I think is a very, very important point. If you're thinking about proper tax planning, you got to think about proper business planning. The two go hand in hand. And you should be knowing that ideally you're working with the same CPA who's doing both for you. I've seen situations where you don't, and it gets a little icky. You got your personal CPA and you got your business CPA, and they're a little bit different. The other thing I'm sure you've been part of too, Carter, is that they're part of a team. If you got an exit strategy 3-5 years down the road, you should be talking about that with your CPA, your partners, and some of your other stakeholders. And it's not something you decide and wake up today, I'm going to leave the business at the end of 6 months, particularly if you built yourself a 10, 20, $30 million business. Lots of considerations, not only financial, sometimes emotional, sometimes tax related, sometimes insurance related, but you need to do that. If you want to share it, and it varies with clients, but sometimes when I'm brought in to help understand the personal side of what's going on in someone's life and have the CPA be part of that discussion, I have found that it makes a more effective team. Every entrepreneur and business owner feels differently about it. Some like to keep close to the vest on what's going on personally. I leave that to be to them. But I do believe that there's a value add for another financial person at the table, particularly if they know what's going on in the business, and particularly if they know you very well, because they become your right-hand person. That CFO can add more value to them.
I agree with that. When we've had that happen over the years, it's always a much better And sometimes having both sides there, you're discussing it. And I think you get a more balanced approach to managing the taxes. I think of it as the taxes, saving them are the icing on the cake versus the be all and end all. And you don't want to damage the business. So you have to do what's best economically, best for your business, but consider the taxes and how can we help there too. And that combination that you're describing with the CFO and the CPA makes for a much better value to the entrepreneur.
Right. And more than likely, they come out with a better scenario, which again, it's not always financial. It's a very important piece of selling your business, but it's not always the main point of why you're getting out. And you can come out in a very, very different way, even though you got a whole lot of money and you're not happy about it. Because sometimes your exit is going to require you being around for a few years, and you need to be prepared for that because you're no longer, you've sold your business and now you're an employee after running your business for 25 years. You've got a whole different set of things you've got to think about. And my final reason, it's cool to say I'll check with my CFO. As I brought up earlier, I just think it's a very good deference action. Checking with someone else with authority buys you time. Also, and maybe you've played this role on the CPA side, but if I'm placed in between a negotiation, so you're the entrepreneur and you have to negotiate out something with your partner, your banker, a buyer, a seller, a vendor, you're always the person in charge as the entrepreneur and owner, but putting somebody in between you in the negotiation puts you in a different position of negotiation. So the hard discussions, the hard back and forths can happen with the CFO in between. That can allow for you to come in and either save the day after someone's playing bad cop or go the reverse way. I've given it away too much, and maybe we even talked about me giving it away too much, and we was intentional about it, and you come in and say no, or I go back to you and I go back and say, I'm sorry, Carter won't go for that. We got to come back with a different solution. But I've been doing that intentionally because we wanted to get to a certain place of dialogue that wasn't happening in the past.
Any other points you want to make, Dominic?
No, I'd be happy to, wrap it up. I've enjoyed this. No other points that I have, Carter.
All right, thank you. Really appreciate your joining us today. Hope that you got some good information from this. I think you did a great job with it, Dominic, and you have quite a team there with your A team.
Thank you, Carter, and you be well, and we'll see you soon.